Sarah and David both have $50,000 sitting in the bank. They both want to become millionaires, and they both make a decision today that will completely change the trajectory of their lives. Sarah takes the clean, simple path. She takes her $50,000, puts it into an S&P 500 index fund, closes her laptop, and goes back to sleep. No stress, no phone calls, just quiet compounding. David takes the messy path. He takes his $50,000 and uses it as a 20% down payment on a $250,000 rental property. He signs a stack of mortgage documents, finds a tenant, and braces himself for the inevitable midnight phone calls about a broken water heater. At first, it looks obvious. Sarah's account grows steadily, while David is stressed, dealing with repairs, and making tiny amounts of cash flow. It looks like Sarah is winning. But the real math tells a different story. 15 years later, one of them has quietly built a massive wealth gap using the bank's money. And the mistake only becomes visible when it is already too late. Let's keep this fair. Sarah and David both earn $70,000 a year. They both have $50,000 saved. They both want to retire with at least $1 million. The only difference is how they choose to invest. Sarah opens a brokerage account and puts the full $50,000 into an S&P 500 index fund. The historical average return is around 10% per year. She sets up automatic contributions, turns off the notifications, and gets on with her life. No tenants, no repairs, no stress, just a number quietly growing in the background. David does something different. He takes that same $50,000 and uses it as a 20% down payment on a $250,000 rental property. He takes out a $200,000 mortgage at around 7% interest. His monthly mortgage payment is roughly $1,330. He rents the property out for $1,700 a month. After property taxes, insurance, and a small maintenance reserve, his monthly cash flow is around $150 to $200. On paper, David is making almost nothing. Sarah's account, on the other hand, is growing at 10% a year. After just 1 year, her $50,000 has grown to $55,000. David's cash flow for the entire year, maybe $1,800. Sarah is ahead, clearly ahead. Her account is growing passively, while David is chasing a tenant who paid rent 3 days late and dealing with a leaking pipe that cost him $400 to fix. From the outside, this looks settled. Sarah made the smart call. David made the complicated one. But there is one number David has that Sarah does not, and that number is about to change everything. Here is the number most people miss when they compare stocks and real estate. David did not invest $50,000 in real estate. He invested $50,000 to control a $250,000 asset. That is a completely different thing. Think about what that means. When that property appreciates in value, it does not appreciate on David's $50,000. It appreciates on the full $250,000. The bank funded 80% of the purchase, but 100% of the gains belong to David. Let's put real numbers on this. Sarah's $50,000 grows at 10% per year. In year 1, she earns $5,000. Her account is now worth $55,000. David's property appreciates at around 3% per year. That sounds much worse. Until you do the math. 3% of $250,000 is $7,500. On a $50,000 investment, that is a 15% return, just from appreciation alone. Sarah earned 10%. David effectively earned 15%, and David's tenant is paying down his mortgage on top of that. This is the concept of leverage, and it is the single biggest reason real estate can quietly outpace the stock market even when the raw appreciation rate looks lower on paper. In the stock market, to use leverage, you need a margin account. The interest rates are high. If the market drops, your broker can force you to sell at the worst possible moment. It is risky, expensive, and most financial advisors will tell you to stay away from it. In real estate, leverage is just called a mortgage. The bank lends you 80% of the purchase price at a fixed rate for 30 years. They cannot call that loan back just because the housing market dips. As long as David's tenant keeps paying rent and covering the mortgage, time is completely on his side. Sarah has one engine working for her. Compounding, David has 4. Appreciation on the full property value. Monthly cash flow from the tenant. the mortgage balance shrinking every single month. And tax advantages we have not even talked about yet. 4 engines versus 1. That is the real race. Let's check in on both of them. Year 5. Sarah's $50,000 has been compounding at 10% annually. It is now worth around $80,500. She has done nothing. She has not thought about it. She has not lost a single night of sleep over it. That is genuinely impressive. David's property has appreciated at 3% per year. It is now worth around $290,000. His original mortgage was $200,000. After 5 years of payments, his remaining balance is roughly $185,000. That means his equity, the portion of the property he actually owns, is around $105,000. Scoreboard at year 5. Sarah, $80,500. David, $105,000. David is ahead, but not by a massive amount, and Sarah still has the easier life. Now let's jump to year 10. Sarah's account has continued compounding. Her $50,000 is now worth around $130,000. 10 years of doing absolutely nothing, and her money has more than doubled. That is the power of the stock market working exactly as it should. David's property is now worth around $335,000. His mortgage balance has dropped to roughly $165,000. His equity is now $170,000, and he has collected around $18,000 to $24,000 in net cash flow over those 10 years, even after accounting for maintenance and occasional vacancies. Add that cash flow to his equity, and David's total wealth from this one investment is somewhere between $188,000 and $194,000. Scoreboard at year 10. Sarah, $130,000. David, roughly $190,000. The gap is growing, and it is not because real estate is magic. It is because David has been using the bank's money to build wealth the entire time. Every month, his tenant has been quietly paying down a debt that belongs to David. That is a wealth-building machine most people completely overlook. But I would be lying if I only showed you David's wins. Because real estate has costs that do not show up in the appreciation numbers. And if you ignore them, you are not doing real math. You are doing fantasy math. The first one is vacancy. David's property will not always have a tenant. The average rental property sits empty for 1 to 2 months every few years. During that time, the mortgage still needs to be paid. The property taxes still come due. The insurance does not pause. David is paying out of his own pocket with zero income coming in. The second one is maintenance. Real estate is a physical asset. Things break, the water heater fails. The roof needs replacing after 15 years. A tenant moves out and leaves the walls needing a fresh coat of paint and the carpets needing replacement. A realistic maintenance budget runs around 1% of the property value per year. On a $250,000 house, that is $2,500 a year. Some years, it is nothing. Other years, it is a $6,000 HVAC replacement that ruins your entire quarter. The third one is illiquidity. If Sarah needs her money tomorrow, she can sell her index fund in minutes. If David needs his money tomorrow, he is stuck. Selling a property takes weeks, sometimes months. And when he does sell, he will pay around 6 to 8% of the sale price in commissions and closing costs. That is $15,000 to $20,000 gone before he sees a single dollar. These are real costs. They are not reasons to avoid real estate, but they are the part of the story that the real estate always wins crowd conveniently leaves out. The honest version of David's returns is lower than the headline number, but here is the thing. Even after accounting for all of that, the math still tends to favor David. And there is one more reason why. Most people have never heard of depreciation, and the ones who have usually think it only applies to cars and machinery. But for real estate investors, depreciation is one of the most powerful tools in the entire tax code. Here is how it works. The IRS assumes that a residential property physically wears out over 27.5 years. So it allows you to deduct a portion of the building's value from your taxable income every single year, even if the property is actually going up in value. On David's $250,000 property, roughly $200,000 of that is the building itself. The rest is land, which cannot be depreciated. Divide $200,000 by 27.5 years, and David gets a paper deduction of around $7,200 every year. What does that mean in practice? It means David can collect rent, generate positive cash flow, and still show a loss on paper when tax time comes. That cash flow is effectively sheltered from income tax. He is keeping more of every dollar his tenant pays him. Sarah does not have this. Every dividend her index fund pays is taxable in the year she receives it. When she eventually sells, she pays capital gains tax on the entire profit. There is no phantom deduction protecting her returns. The tax differential between these two paths is not a small rounding error. Studies suggest it can add 2 to 4 percentage points to real estate's effective annual return compared to an equivalent stock investment. That is the part of the story that never makes it onto the comparison charts, and it is one of the main reasons the wealthy keep buying property even when the stock market is performing well. So who gets to $1 million first? Let's run it out to year 15. Sarah's $50,000, compounding at 10% annually, is now worth around $209,000. That is a genuinely remarkable result from a completely passive investment. She has never called a plumber. She has never chased a late rent payment. She has never lost sleep over a vacancy. Her money just grew. But Sarah is not close to $1 million yet. To get there from $209,000, she needs roughly another 12 years of compounding at the same rate. She reaches $1 million somewhere around year 27. David's property is now worth around $390,000. His mortgage balance has dropped to roughly $150,000. His equity is $240,000. If David has been disciplined and used his cash flow and tax savings to purchase a second property around year 7 or 8, his total real estate equity by year 15 is closer to $400,000 to $450,000. With 2 properties compounding through leverage, David reaches $1 million in net real estate equity somewhere around year 18 to 20. David wins the race, not by a decade, but by a meaningful margin. And he gets there with a strategy that most people dismiss as too complicated, too stressful, or too risky. The gap is not about intelligence. It is about understanding how leverage and time work together. I would be lying if I said Sarah's path never makes sense. If you are a surgeon, a lawyer, or anyone whose time is genuinely worth hundreds of dollars an hour, the extra returns of real estate may not be worth the operational headaches. Real estate is not passive income. It is a part-time job with a good salary. And if you are the kind of person who would panic and sell your index fund the moment the market drops 20%, then real estate's forced illiquidity is actually your greatest protection. You cannot panic sell a house at 3 a.m. The math changes when your situation changes. Be honest about which investor you actually are. Sarah and David both made smart decisions. They both invested. They both stayed consistent, and they both built real wealth from a single $50,000 starting point. The difference was not intelligence. It was not luck. It was structure. David chose the harder path, the path with tenants, repairs, and paperwork. But he also chose the path where the bank works for him, where the tax code rewards him, and where 4 engines compound his wealth simultaneously instead of one. The question was never stocks or real estate. The real question is this: which kind of hard are you willing to live with? Because both paths have a cost. The stock market costs you patience and emotional discipline. Real estate costs you time, stress, and sleepless nights. Choose your hard, then commit to it completely.